Welcome, my friends. There is more financial trouble in the industrial sector. U.S. Steel has announced that it will explore strategic alternatives for the company. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Steel producer United States Steel said on Sunday it is initiating a formal review to evaluate strategic alternatives for the steel producer after receiving multiple unsolicited bids for part or all of its business. The review was begun after the steel producer received multiple unsolicited proposals that ranged from the acquisition of certain production assets to consideration for the whole company, CEO David Burritt said in a statement, without disclosing details about the strategic alternatives. Barclays Capital and Goldman Sachs are serving as financial advisors to U.S. Steel, while Milbank and Wachtell, Lipton, Rosen and Katz are acting as legal advisors, the steel producer said. U.S. Steel, which has been raising prices to offset the impact of higher costs related to raw materials and energy, has seen strong demand for its steel products, helping the company beat profit estimates for the second quarter. U.S. Steel also expects to complete about $75 million of repurchases of common stock in the second quarter under its existing $500 million stock buyback authorization. United States Steel Corporation, U.S. Steel, is an American integrated steel producer headquartered in Pittsburgh, Pennsylvania. It was formed with the joining of American business icons Andrew Carnegie, J.P. Morgan and Charles Schwab, led by Elbert H. Gary, U.S. Steel's first chairman. U.S. Steel has production operations primarily in the United States of America and in Central Europe. The history of U.S. Steel, often known as United States Steel Corporation, is closely intertwined with the growth and development of the American steel industry. U.S. Steel was one of the first billion-dollar corporations in the United States and played a significant role in shaping the country's industrial landscape. Here's a brief overview of its history. Formation and early years, 1901 to 1910s, U.S. Steel was founded in 1901 by a group of prominent industrialists, including Andrew Carnegie, J.P. Morgan, and Charles M. Schwab. The corporation was formed by combining several major steel companies, most notably Carnegie Steel Company, which was owned by Andrew Carnegie. The new corporation aimed to consolidate and control a significant portion of the steel industry, capitalizing on the rapid industrialization and demand for steel products at the turn of the 20th century. Dominance and expansion, 1920s-1950s, U.S. Steel quickly became one of the largest and most powerful companies in the world. It controlled a substantial portion of the American steel production and played a crucial role in supporting various industries, including construction, transportation, and manufacturing. During World War II, U.S. Steel's production capabilities were vital for the war effort. However, the corporation faced criticism for labor practices and anti-competitive behavior, leading to legal challenges. Decline and challenges, 1960s-1980s, the post-World War II period saw challenges for U.S. Steel. The rise of international competition, particularly from more efficient and cost-effective foreign steel producers, eroded its dominant position. The company also struggled with outdated facilities, high labor costs, and environmental concerns. This period marked a decline in U.S. Steel's market share and profitability. Restructuring and modernization, 1990s-2000s. In an effort to adapt to changing market conditions, U.S. Steel underwent significant restructuring and modernization. The company closed outdated facilities, improved efficiency, and invested in technology and innovation. It also focused on producing higher-value steel products for specialized industries like automotive and aerospace. Recent developments, 2010s present, U.S. Steel continued to face challenges from global competition, economic fluctuations, and changing demand patterns. The company invested in sustainable practices and modernization efforts to remain relevant in the 21st century. However, its position as a dominant force in the industry was surpassed by other international steel producers. The history of U.S. Steel reflects broader trends in the American economy, including the rise and fall of industrial giants, shifts in labor relations, and the impact of globalization. While U.S. Steel's prominence has waned over the years, it remains a symbol of America's industrial history and its pivotal role in shaping the country's development. The production of steel in the United States has evolved over the years due to a combination of economic, technological, and global factors. While the U.S. was once a dominant player in the global steel industry, its share of production has decreased over time. Several key factors contribute to the relatively lower steel production in the U.S. today. Globalization and competition. The global steel industry has become highly competitive, with countries around the world producing steel at varying costs. Some countries have developed more cost-effective methods of steel production, often benefiting from lower labor costs, regulatory environments, and access to raw materials. As a result, U.S. steel producers face competition from international companies that can produce steel more efficiently and at a lower cost. Labor costs. Labor costs in the United States are generally higher compared to many other countries, which can impact the cost of production. Steel manufacturing is a labor-intensive industry, and higher wages can lead to increased production costs. Technological advances. Modern steel production has become highly automated and technologically advanced. Some countries have invested significantly in state-of-the-art steelmaking processes and facilities, allowing them to produce steel more efficiently. U.S. steel producers have had to invest in similar technology to remain competitive, but the transition can be costly and time-consuming. Environmental regulations. Steel production is resource-intensive and can have significant environmental impacts. In the United States, strict environmental regulations have been implemented to address air and water pollution, as well as carbon emissions. While these regulations are important for environmental protection, they can add to the costs of steel production, potentially making it less competitive compared to countries with less stringent regulations. Access to raw materials. The availability and cost of raw materials, such as iron ore and coal, play a significant role in steel production. Some countries have more abundant and accessible sources of these materials, giving them a competitive advantage in steel manufacturing. Changing demand. The demand for steel has shifted over the years. While steel remains a vital material in construction, infrastructure, and manufacturing, the demand growth rate has changed. Sectors like automotive and consumer electronics require specialized steel products, which may not be produced in large volumes in the U.S. Trade dynamics. International trade agreements, tariffs, and trade policies can also impact the competitiveness of domestic steel production. Trade disputes and market access can influence the flow of steel products into and out of the country. Industry consolidation and restructuring. The U.S. steel industry has undergone significant consolidation and restructuring, leading to the closure of less efficient facilities. While this has improved efficiency, it has also reduced overall production capacity. Overall, the decrease in steel production in the United States is the result of complex interactions between economic, technological, regulatory, and global factors. While the U.S. remains a significant steel producer, it has faced challenges in maintaining the high levels of production it once enjoyed. U.S. Steel could become the next big corporate bankruptcy in the United States. Yellow Corp, the third largest less-than-truckload freight company in the United States, plans to declare bankruptcy on Monday according to a new report. The Stephens analysts estimated that Yellow spent $20 to $25 million in cash just in the last week and that it could be losing as much as $10 million a day due to the drop in volume. $35 million in cash is the threshold set by Yellow's lenders, led by Apollo Global Management, in an agreement between lenders and the company earlier this summer to relax Yellow's debt conditions in exchange for direct oversight of Yellow's finances by lenders. Wall Street, however, has made it clear it will not inject additional cash without major cuts at Yellow. Over the past few years, Yellow has worked to implement its One Yellow plan, a consolidation of its subsidiaries including the closure of several hubs and the conversion of many jobs into utility positions, in which workers both drive trucks and work the docks. Yellow's investors have demanded that Yellow demonstrate its ability to eliminate jobs and cut pay and benefits before it is given another infusion of cash. Yellow is the third largest LTL company and employs some 30,000 workers, including around 22,000 Teamsters members. The trucking company had an operating revenue of $5.245 billion in 2022. On a specific industry basis, the financial sector is under duress following the collapse of Silicon Valley Bank, with multiple other institutions following suit in recent weeks. Retailers from Bed Bath & Beyond to David's Bridal have filed for bankruptcy in recent weeks. Envision Healthcare, a medical staffing company backed by KKR, was one of the 6 firms to declare alongside Vice. What this assorted list shows is that no industry is safe from balance sheet bogeys. If a company got too aggressive loading up on debt during the low interest rate era, chances are it will soon be feeling the pain. And, the recent bankruptcy of Vice Media is still fresh in everyone's mind. Once a digital media darling, Vice Media Group on Monday filed for bankruptcy protection after years of financial troubles. If you follow this channel, you already know that the entire media space is experiencing huge numbers of layoffs right now. Earlier this year, Disney said it would slash 7,000 jobs from its workforce as part of a larger reorganization of the company that will see it cut costs by $5.5 billion. The announcement was made during Bob Iger's first earnings call since returning as CEO. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.